We did our August.
But I'm talking here about massive fiscal stimulus, tax cuts, and whilst you're right, we don't absolutely know the detail. I think we'd be pretty sure that the NI cut will occur, the corporation tax increases will be stopped. We can be pretty certain that there will be a multiple tens of billions of pounds pumped into supporting consumers and businesses with their energy costs. So, I mean, is that something that concerns you? Do you think it's going to have some effect on inflation, or are you relaxed about that kind of scenario?
Well, I think we have to. I do think we have to see the details. I don't really want to comment in the absence of those details. What I would do is draw a distinction between two implications for inflation, and also emphasize that there may be differences between the impact on inflation today in the short term and the implications over the medium term. So one of the things that does seem to be under consideration, at least from what I gather from the headlines I see that we all see, is a change to the relationship between wholesale gas prices and retail gas prices in a direction that will lower headline inflation relative to what we were forecasting in our August report, where that relationship was based on the mechanics of the off-gem price gap and so forth that we all know about. So I think that in the short term would tend to weigh on inflation. Against that, some of the implications of supporting household incomes, particularly household incomes towards the less well-off households, would tend to support demand in the economy. And that, other things equal, would probably lead to slightly stronger inflation. Net, on the implications for headline inflation in the short term, I would expect that to see a decline. Right. The open question, and perhaps the more important question from a monetary policy point of view, is what are the implications of these changes and the other fiscal changes that you mentioned, which I don't have good insight into, but have also been flagged. I mean, what are the implications of those for inflation at the, what we typically label monetary policy relevant horizon, which is the horizon at which the lags in monetary policy unwind, decisions we make today, how they affect inflation in the future. And I think there, not only does it depend on the macroeconomic effects of the various fiscal changes that could be envisaged, which I think is the essence of your question, where I think there's just too much uncertainty to have a strong view right now, given the lack of details. But it would also depend on whether, and if so, how, the introduction of some different form of price cap would be exited from.
Let's just go for that point for a second. So we don't know the nature of the support exactly, but it seems to me that speculation is it could be subsidies going into energy suppliers and effectively freezing at the new cap in October at that sort of level, so consumers are protected in that way. So with the borrowing effectively going into the suppliers to keep the price down. Or you could have a model at the other end of the spectrum, I guess, where you allow the prices subject to the caps to go wherever it goes, and you put direct transfer payments into individuals and businesses to try and support them to cope with that. Of those two scenarios, is one of them broadly better for inflation than the other, and if so, why?
I think they potentially have different implications for inflation in the short term. So one thing that we have learned since the publication of our report is the decision of the ONS to treat the measures, which were more, if I understand correctly what you're saying, in the second scenario, the second speculation, to use your word that you used. I mean, those do not have been decided that those would not influence CPI inflation, the variable that we are targeting at the bank. They won't be included in the calculation or their implications would not be taken out of the calculation of CPI. So there is an implication for inflation depending on which of those. Now, the point I was making in my previous answer is that it's that very short-term impact on inflation may not be the most important thing from the monetary policy point of view. The monetary policy point of view is what's the implication of the package of measures, which I think goes beyond what you have just speculated on, and in ways that I would not want to speculate on. It's not my responsibility, and I don't think it's really appropriate for me to do so at this occasion. But what are the implications of that for inflation at longer horizons?
Thank you very much. That's very helpful. Andrew, as this all plays out, the markets are reacting. I'm thinking here about sterling and the bond markets, where we've seen highest sort of yields on 10-year gilts for about a decade, 2011, I think. Does that worry you, and what do you think is going on there, and what concerns might you have around sterling and the bond markets?
Well, we have had, I think, volatile markets, and particularly volatile markets in the last, six weeks or so. And I think there are a number of reasons for that. I mean, one obvious one is the point that Hugh has been making, which is that, of course, we're seeing extreme volatility in energy markets. And I'm happy to come back to that point if you want with a reflection. And I think that is playing through, and of course, it's not just in our markets. I think the second thing I would say is that I do. It's not for us to comment on what fiscal policy will be, and we'll wait and see what it is, and then, as he said, factor it into our assessment. But I do very much welcome the fact that there will be, as I understand it, announcements this week, because I think that will help to sort of, in a sense, frame policy, and that's important. And I think it's important there's a sort of clear way forward on policy. So I welcome that, because I think that is what will be important for markets to understand what is going to happen.
Well, why do you think the markets are getting a bit wobbly on UK debt and a bit sniffy about the pound? What do you think is going on there?
Well, I think there's a number of things going on. Some of them are UK specific, and some of them are not. I think, as I say, on the UK specific point, I would just simply make the point that I think it is welcome that we will have a very clear policy stance, as I expect by the end of this week. I would say on the exchange rate that I think it's important that there are other factors at work there. I think there are dollar specific factors. So the dollar is strong against almost all currencies at the moment. And that's an important part of it. And that reflects the fact, I think, as we've discussed before, that the US is in the Federal Reserve is in a different situation. I mean, they don't have the same trade-off that we have and the ECB have in terms of inflation and activity. They're dealing much more with bringing under control a demand shock in that sense. And obviously taking aggressive action in response to that. And you'll have no doubt seen the speech that Chairman Powell made.
But why do you think that the markets are getting a bit twitchy at the moment on
well, my point was that part of the story is about the strength of the dollar.
Right.
Because you can trace that through. I mean, for instance, the movement of sterling is much greater against the dollar than it is against other currencies. So I think there's a part of the story that is not UK specific. It's actually a more general dollar story in the exchange markets. I think there is as I said, I think there is a UK story. Now I think there are one or two reasons for that. I'll give them one, which is I welcome the fact that the government is going to set out its policy this week. Secondly, the UK is heavily exposed to gas prices. I mean, if you look at the relative exposures, the UK is a...
Do you think, Andrew, sorry to stop you there, do you think the markets are concerned about this fiscal event that's about to occur, the magnitude of what might be done, its affordability, its effect on inflation, that it might be quite inflationary? Do you think there's a concern out there about that? And if there is, do you share any of that?
My view on it at the moment is that it's more, I think it's more a sense of, we've obviously got through the process we have. We understand that process had to happen, and I think now it's important that we have policy laid out clearly. and all I sense is that will happen, and I welcome that.
All right. I want to come a bit later. I'm going to bring Angela in now because I know she has to go shortly, but I did want to ask Silvana and Catherine a few questions as well. But I'll go to Angela now.
I appreciate that, Chair. Governor, is inflation high because of excessive money supply?
I don't think that you can use the money supply in that sense, as some people do advocate, I know, as a sort of rather sort of straightforward and direct indicator of inflation. History tells us that relationship may have held some time, quite a long time in the past, but it broke down on a number of occasions in more recent history. So we I should say, use and do look at elements of the money supply very carefully. So I'll give you one we were looking at yesterday, in fact, which is looking at household M4 as a means of getting a read on the level of excess savings still in the system that built up during COVID. So we use it. But I would caution, I think like many people do, that I think a direct trying to do a direct relationship with what I might call aggregate money supply and inflation. I mean, that has broken down a lot of times over the years, so I would not go there.
Perhaps you'd have a word with the new Prime Minister who gave that as the reason for spiralling levels of inflation during the Tory leadership campaign. A quick seminar might be quite useful at this stage. Do you think Governor of the Bank's remit is outdated?
I think the inflation target and the nominal anchor that we get from that is very important. It has proved to be very successful over the years. So I mean, one thing to observe is that in the 25 years since this regime came into existence, certainly up until the last few months, actually inflation has averaged pretty much exactly on target. This is, by far the biggest shock we are facing during the life of that, but it does not suggest that the regime has failed. What it suggests is that the regime now has to do its work and respond to a much bigger shock, and I'm confident that it will do so, and we will do so. Now, can I just say, because I think I may be anticipating you, and shoot me down if I am. The question of review has come up. I'm happy to discuss that. I haven't discussed that at all yet. All I would say is this: it is quite good practice. Other central banks, and we've done past, it is good practice from time to time to have reviews. So I would not, in any sense, want to stand in the way of that. But I would say that this is not a recognition of the fact that the regime is in some sense failing, not at all. But we can always learn from the experiences we have, and we've had an awful lot of experiences in the last 2.5 years.
Yes, again, I'm one of those that prefers life to be boring rather than as exciting as we've had to live through in the last few years. Yeah. There's no analysis of the state of the UK's international trade in the latest monetary policy report, but we are a very, very open economy, and it's likely that a lot of the inflation that we are experiencing, vast bulk of it, is imported. Don't you think that's a major problem for your analysis, that we don't know what's happening with international trade, or you don't feel able to report on it?
Well, I might bring Hugh back in if you don't mind on this. One thing I would say is, and I think Hugh follows this very closely, is that we've had, and there are some issues with the trade statistics at the moment. Now, I'm not criticising the ONS for that, because they've been quite open in actually in actually warning on this. But there was a change in methodology, and that has led to difficulties in interpreting them.
I mean, has Brexit also distorted the trade flows so you don't feel you can measure them properly?
Well, I think there's a very big puzzle in there on the import side, certainly.
Just to go back a few steps, the first thing is, I think the reason why we have high inflation, measured inflation on the CPI today, is a consequence of developments in energy prices. So when we talk about energy crisis, that is having implications for the UK economy across many dimensions. One dimension of that is onto CPI inflation through the mechanics that we discussed in the first question. I think we are committed, as the Governor has said, to addressing that shock in a way that returns inflation to target. And so it is a time, in my view at least, to emphasise the importance of the target as the anchor, rather than consider deviations from that, a new regime. And in returning inflation to target, we will look across all the indicators we need to look at, including money, but not just money, because the economy is a complex place where money plays a role, but it doesn't play necessarily a dominant role, certainly not in all circumstances. And I think that's the mechanism by which, in response to the sort of question, will fiscal policies generate inflation? We are here to ensure that they don't generate inflation. So fiscal policies will have their own dynamics, as will other shocks to the economy. We as the central bank, our role is, our mandate is, our remit is to return inflation to target. And I think that's what we're trying to do. That is what we are doing. That is what we will do. So coming specifically to the question on trade, I think there you are right to say, and what I just discussed is an illustration of, for what is a small open economy by global standards, shocks occurring at the global level have a very big effect on us, and we need to be able to respond to those nimbly, and our remit in the bank at the MPC is to get inflation back to target. So that's the mechanism which we're doing. Obviously, the more information we can have about the character and nature of those shocks, whether they're coming through money or coming through trade or coming through energy prices, the better job we can do. We have a very good relationship with the ONS. The ONS is collaborating with us in order to give us the best insight we can have into the developments, including trade developments. As the Governor said, the fact of Brexit has led to a change in the way data are collected. That has led to a break in the series and big jumps, certainly in the import data, but also to some extent in the export data, which renders the trade data difficult to interpret. And we are closely collaborating with our colleagues at the ONS to try and resolve that set of issues. What I think is important also to see is the trade data, by its nature, feeds in to our assessment of overall activity in the economy. So it feeds into our measurement of the national accounts and so forth. At the moment, there is a big so-called adjustment which is required to reconcile the expenditure measure of activity with the income and output measures of activity. In collaboration with the ONS, we think that the better measure of activity in the economy is actually, in the shorter term, the output measure. And that is less affected by these distortions to the trade data. So in terms of thinking about aggregate activity in the economy, which is a crucial element of how we assess demand and supply pressures and so forth, which is a big driver of our view of inflation, I think we are to some extent insulated from being misguided by the weaknesses in the trade statistics. But certainly if we want to go into more detail and we want to understand developments in different elements of expenditure, then we do need to reconcile or improve the quality of the trade statistics. And hopefully through time that will occur as we get used to the new systems, and the ONS using HMRC sources and other things can replace the former system provided by the EU.
It might be good to have some idea when you feel that we could rely on your interpretation of trade data in the future as these changes work their way through, because we are essentially sort of a bit blind to what's going on until that is resolved, which is a worry.
Just to illustrate it. That's gone.
Sorry.
Just to illustrate it, the UK measurement of imports from the EU currently doesn't match with the EU measure of exports to the UK, for instance. That's the one way of Sorry, Silvana.
Just to add to what Hugh has said, we also obviously track measures of prices. Tradable goods prices have played a big role at the end of the pandemic, with inflation on those tradable goods prices going up quite significantly because of the rotation in global demand from services to goods. Now that has eased some, and we have seen a decline in that tradable goods price inflation, and so that's part of the decomposition in our CPI. And what took over was the enormous increase in energy prices that we've seen since the war and even before with the build-up to the war.
Thank you. Governor, finally, I just wanted to ask about the contradiction really between a new Prime Minister who wants growth and has said she's going to put growth first, but inflation being as high as it is implies a series of quite large increases in interest rates to have some effect on rates of inflation. And as you said earlier, the Federal Reserve chair has indicated that in America they'll be pursuing a far more aggressive increase in interest rates, which kind of works, we all know, by reducing economic activity rather than increasing it, and if you get it wrong can actually cause recession and unemployment. How is this square going to be settled in the UK?
Well, obviously I can't speak for the Prime Minister, but let me, I think, make a point which may help on that front. I think when we talk about growth in the UK economy, it's important to look at this in the longer run context, that the trend rate of growth has fallen over the last certainly 15 years. Now that's important because obviously that's an underlying driver of growth. Now you can map that into the current situation again if you do the US and UK comparison. The reason I said the Federal Reserve is in a different place, or one reason the Federal Reserve is in a different place, is because growth in the US economy has now returned to its pre-COVID trend whereas in the UK we're just above the level pre-COVID. That's a very different situation to be in. Now we've got the trade-off caused by gas prices. The US hasn't got that same trade-off, so we are, as Hugh was saying, in different situations also in that respect. But the growth point, I think, needs to be seen through the longer-term lens that we have had, as I say, low trend growth. We've had low productivity growth in this country for at least 15 years. I think it goes back actually now a bit before the financial crisis. Actually, it's not solely a product of the post-financial crisis situation. And there's no question that if we're going to address that, then growth is important, and there isn't a contradiction in that sense, because I would draw this distinction between where we are in the short term and the underlying issue of growth in the economy.
So possibly a recession to get inflation down, and then hoping for growth later on, increases in trend growth. The
recession, going back to what, I hope it doesn't happen, but obviously we have forecast it because we think it is sadly the most likely outcome, of course, is overwhelmingly caused by the actions of Russia and the impact on energy prices.
Thank you, Chair.
Thanks very much, Angela.
If I could add
Catherine,
a comment. Yeah, if I could add a comment here, is that elements of both the Powell speech and the Schnabel speech at Jackson Hole also noted that the role of monetary policy in affecting inflation expectations, and the extent to which you can affect inflation expectations, you are less dependent on the aggregate demand channel, this sort of squeezing the economy, trying to, reducing growth. By affecting expectations in advance, you don't have to depend as much on this aggregate demand channel. And I think with the fact that both of those governors noted the expectations channel, and of course I talked about it extensively in my speech at Kent on Monday, there is a role for monetary policy to reflect inflation expectations, and I think that's something that is an important part of our tool chest that we are deploying as part of our strategy in monetary policy making.
Catherine, on that, so you voted for the 0.5% increase. Silvana
Yes.
was 0.25%, and you've been consistently, I think, more hawkish through time
Yep.
at the various MPC meetings. Is it centred on this point that you're making about trying to control those inflationary expectations and their central importance to what the bank is doing? Do you want to just tell us a bit more about that? Why were you at 50 basis points and Silvana's at 25?
Right.
Well, what's the difference between you?
Well, the data that I look at in order to evaluate whether or not there's the short-term inflation that Hugh in particular has talked about, and others, the energy price inflation, it's very real, it's very salient to households, it's very important for business. Those short-term inflation spikes are becoming increasingly embedded in more domestic-oriented prices. There are a number of different models that we use to evaluate underlying trend inflation, medium-term inflation expectations. The DMP survey, the Decision Maker Panel survey, for example, tells us something about that. Our financial market data tell us something about medium-term inflation expectations. Those medium-term inflation expectations are domestically driven. They have risen. They have been rising for a while. We talk about embeddedness. We talk about inflation persistence. Those two words come from looking at the extent to which these short-term inflation spikes that are coming from external sources become part of the fabric of domestic inflationary forces. We want to lean against those changes in medium-term expectations, because once those medium-term expectations become embedded in inflation outcomes, then it's more difficult for us to get inflation down, and we have to increasingly depend on the aggregate demand channel, the squeezing of the economy. So I voted for 50 basis points for a number of different meetings here because of my view that inflation, the external sources of inflation have increasingly become embedded in the domestic inflationary pressures.
Okay, I'm going to come straight to Kevin in a sec, but can I turn to you, Silvana, on that point? So I'm sure you agreed with a lot of that in terms of the mechanisms of what's going on and the second round effects and so on. Why were you at 25 basis points? Where's the point of disagreement between yourself and Catherine?
My vote was strongly influenced by our forecast in August under different assumptions for energy prices. All of this suggested to me that a bank rate at 1.25%, what we had at the time, was more likely than not to bring inflation to target in the medium term, which is our focus. Those forecasts have demand weakening, which we are already starting to see in the data. We also have put in place a significant amount of policy tightening, much of which will feed through to the economy with some lag. In my central case, even without a bank rate increase back in August, that would have been enough to bring inflation back to target once external shock drops out of the calculation. Now, despite that, I voted for an increase of bank rate to 1.5% because I saw similar risks. There are two big risks to the central case. First, there is a lot of uncertainty, as we've just been discussing. And that implies that there's uncertainty on exactly what level of bank rate would be needed. The typical sequence following a tightening of monetary policy is that demand first weakens, then that feeds through to the labor market, and then that goes into wages and prices. Now, we're at the very start of that sequence with demand weakening. As Catherine said, domestic costs and prices have accelerated recently. They are not slowing yet. So I thought there was a case for raising further until we saw firmer data that we've done definitely enough. And second, I share, again, the concerns that with a very high rate of headline inflation, that could feed through to the wage price dynamics. There was a case for further tightening to lean against the risk of those second round effects. But so going back to my central case compared to some of my colleagues, I think I felt there were more likely to be costs associated to the increase in bank rate, as well as weakening demand further. They are more likely to oversteer inflation below target in the medium term. So I judged that the more gradual pace of tightening would allow us to guard or reduce those risks, because we would see the effects on the data and we can always stop or reassess course before bank rate is too far deep into contractionary territory. So it's about going slowly when there is a lot of uncertainty, and that was my judgment back in August.
Very clear. Did you, Harriet, were you wanted to get in quickly? No. I misunderstood. Kevin.
Thank you, Chair. Hugh, can I just ask you first? I think you said in your earlier remarks that net, considering everything, what the government's likely to do and what you've done already, there's now an expectation of a decline in terms of your prediction of headline inflation, presumably something lower than 13%, which I think is central forecast. So what kind of decline?
So, I mean, I am reluctant in the spirit of what the chairman said at the beginning. We have our meeting next week. We haven't heard any details. I'm reluctant. We will hear more over the next few days. We will produce a forecast for the November meeting, the November Monetary Policy Report. I think to speculate too much would not be probably very instructive or informative, to be frank.
Okay. Silvana, if I can just ask you first, you voted for that lower increase. Do you think now that 1.5% is as high as it needs to go?
Well, as I said, given the uncertainty, my strategy would be to consider further tightenings until we see firmer evidence that we are more we've progressed in that sequence. That
as high as you think it needs to go.
Exactly, as in that sequence.
You might think interest rates might peak at 1.5 in your view, should do.
we will see the data, and obviously there are many changes put in place right now, and we will have to reassess what that implies for medium-term inflation expectations, because inflation, because that's ultimately what we can affect with monetary policy today.
Hugh, just come back to you again. You said that the majority of inflation is driven by energy prices. What proportion?
Well, I mean, I think the easiest thing is to give concrete numbers based on the August monetary policy report, because that is an exercise that was, thoroughly worked out, and I guess is the basis for this discussion. I mean, I do want to recognise up front, a lot has happened to wholesale energy prices in both directions in the period since then, so there is a need to update, and that feeds in against the context of changes in the policy framework for energy prices. But if we take the August monetary policy report as the benchmark, the direct effect of the rise in wholesale energy prices that took place over the year to the assumption added approaching 7 percentage points to inflation in terms of our forecast. Beyond that, there are what we would call indirect effects. So those are the impact of, so just to be clear, the direct effects are the rises essentially in utility and fuel prices. The indirect effects are the consequences of those rises in utility prices on, say, just to take one example, the price of a meal in a restaurant, because that restaurant has to pay more for its electricity bill to cook. So, I mean, as a rule of thumb, rules of thumb have their pros and cons, we typically think that indirect effect is around a third. Right. So you might be adding another 2.5 or so percentage points on the basis of that. So you're getting to sort of 10 percentage points of the 13%, which one could argue are coming from the impact of this rise in wholesale energy prices. Yeah. Now, of course, we've discussed a little bit. Catherine emphasised the role of expectations. Catherine emphasised the role of second-round effects, and the fact that there is a danger, and this is the core of our policy discussion, a danger of this impact coming from abroad becoming embedded in domestic cost developments, price developments, and so forth. Yeah. I would not want to push back that we don't have work to do. We do have work to do. But I think it is important to see that the role of energy prices has been massive over the year, leading to that 13% forecast. Leading to that 13% inflation forecast. Yeah. And I think it goes to, hopefully, both reflected in the wider policy debate, but also the consequence or the message of what was in the August monetary policy report is just to emphasize the magnitude of this shock coming from energy prices, and the fact that it was a genuine shock in the sense that certainly a year and a half ago, at the time when monetary policy decisions could have been taken to offset that, I mean, that was actually before I started working at the bank, there was no consideration at that point that we were going to see an invasion and we were going to have this development and so forth. So I think it's this combination of it was a shock in that narrow sense, and it is massive by any historical benchmark, and it has a direct effect on our target variables, CPI inflation in the UK, at a pace that is quicker than monetary policy actions through the channels, at least that Silvana's been emphasising, would feed their way through the system, is the reason why we've seen this volatility or rise in inflation that has been so substantial.
Could I... this
might help. You in a second, I was just
going to illustrate Hugh's point, just with a quick... I find this helpful. If you look at household spending on gas and electricity as a share of household income, and to Hugh's point about what's implied in that forecast for the spring, it could be 7 percentage points higher than it was in 2019, if we go back to the pre-COVID. The comparable number in the 1970s is 1.5. So that's the measure of this thing.
I mean, that may be true, but in all scenarios, even if you left interest rates as they are today, inflation gets back to target within 2 years. Even at the end of next year, it's down back to 4%, that's your central. Yet, you're inflicting what you're doing. I understand why you're doing it, and you get a lot of criticism for not acting earlier in terms of increasing interest rates. But by your own admission, what you're doing isn't really affecting the principal drivers of inflation. Yet you're going to inflict a huge amount of pain, on the British economy. So you're going to slow down the economy, probably drive it into recession by increasing interest rates. And you're going to put households under a huge amount of pressure. What's the point just to get to inflation back to target a few months earlier?
Well, can I just say, as I said earlier, I'm afraid, and I'm going to say this quite starkly, the person who's going to put this economy into recession is Vladimir Putin, not the MPC. But let me make that point, because I think it comes to the sort of the points that Silvana and Catherine have made. Let me start with Silvana's point. The economy is undergoing a huge shock to real income. That feeds through, as Silvana has said, and there is a very good sort of argument which we've developed and others have developed that if that happens, as you might expect it to happen, it will bring inflation back down to target through the income effects and the demand effects. The point Catherine's making, and obviously I voted the same way as Catherine, as you know, is that we've had, to the points that Hugh has made, these increasing effects from energy prices, and as the actuality and the expectation of headline inflation have gone up so much, Catherine is making the point that there is a very real risk here, and the risks in our forecast are to the upside, I'm afraid, at this end point in the forecast. That will have an effect on expectations, that will come through into price setting. And that is the reason why I voted in the same way that Catherine did, because I'm very concerned that we will get greater inflation persistence through that.
I get that.
Because people, I'm not being critical, I understand it completely. People will say, well, this is where inflation is going, and we've got to protect ourselves against that, and then it becomes embedded.
A YouGov survey said that people's expectations with inflation is actually now dropping. So that expectation curve looks different now from what it did previously.
Let's pick the expectation story apart for a moment. So short-run inflation expectations, I'm afraid, have risen substantially. Now that's not necessarily surprising because they tend to follow actual inflation, released inflation. When we look across I think it's important to look across all the measures, and if you don't mind me saying so, not to pick out one, we have seen, this is Catherine's point, some upward movement in the medium and longer term measures of inflation expectations. Not all of them, and by the way, the survey of professional forecasters, think that we will bring inflation back to target. But we have seen some upward movement in medium and longer term inflation expectations, and that's why we have to be very, very alert to that.
Are you speaking to this survey? You give survey reports that households' medium-term expectations have fallen in 3 of the last 4 months.
Yeah, but there are, if you don't mind.
Can I clarify one thing? Yeah, because I think Andrew described it nicely in qualitative terms, putting it very starkly, Catherine versus Silvana, but I think we're talking about degrees here. Obviously, I recognize the risk that higher headline inflation can feed into wage price dynamics. It's a matter of degrees, how much weight I'm putting in terms of risks and how that affects medium-term inflation expectations. But that's part of the rationale for me to vote for an increase, is precisely that risk. Perhaps others put more weight on it, but I agree that that's an important one. On expectations, typically short-term measures of expectations tend to follow quite closely spot inflation, what's going on with inflation. And so they tend to be very volatile. And in a speech I gave a couple of years ago, I set out why those short-term inflation expectations have very little predictive power, little information about future macroeconomic developments. They tend to be more reflective of spot inflation.
It is relevant to expectations, which was quoted earlier. Chair, I think I'm out of time, sadly.
Mm-hmm. Thanks very much, Kevin. Come to Rushanara, please.
Thank you very much. So could you, Governor, run us through when people should expect inflation to return to target? I appreciate the uncertainties, but obviously given the target is at 2%, so it's supposed to be 2%, and you're predicting up to 13%. when can people expect to see that happen? If you could just remind viewers, but also how do you see interest rates growth? We've seen a very steep increase. How do you see that happening? Is it going to evolve gradually, or is it going to be quite dramatic? Those are the two questions I think our constituents really need to understand in terms of planning and household management and so on.
I mean, can I please, I think the second question gets us quite into the territory that the Chair said at the beginning. We are, we would always be cautious about talking about that, and we're particularly cautious about because we're into a meeting cycle, and as the Chair said, I'm very clear that nothing we say this morning can be taken as a clue on what we're going to do next week, because we've got a lot of hours to spend together to talk about that before we get there. On your first question, so going back to, as Hugh said, to the profile that we published in the August report, we have inflation returning, and then as Mr. Hollingworth was saying, going somewhat below target, really through the sort of into the second and third year of the forecast. Now, I think it's important to bear in mind as an arithmetical point here that it's an annual measure of inflation, so that you get these sort of, in effect, built-in annual effects. And one of the reasons why if you look at the August report compared to the May report, we've got higher inflation persisting into the second half of next year. That's because of the impact of the sheer rise in energy prices that we've seen in the second half of this year. So the basic picture looks the same. It comes down, but it's somewhat delayed coming down because of these, not least because of these arithmetical effects going on. Now, of course, our target is, of course, is that it should be at target at all times, but we have flexibility in how we bring it back to target. But a good deal of that is being driven by the dynamics of the energy market at the moment. And the way just to finish on that, the way we forecast energy, and particularly gas, is that we use the first part of the sort of the market curve, and then we actually fix it flat thereafter. But we have taken in recent reports to showing two versions of the forecast, with the second one having the full curve, and the full curve tends to come off rather more than the flat pattern. Unfortunately, of course, the flat pattern, if you like, has been neither of them has been particularly close to reality, but has been nearer because of the sheer upward pressure on prices, so that we keep getting this sort of pushing out of the curve. But the full futures curve brings inflation down somewhat faster. That's the difference between them, essentially.
Okay, but in essence, what we've heard so far suggests that there is going to be a major consequence in terms of recession if we do head in the direction that needs to happen. How that happens is, you appreciate you can't get into the detail, but if interest rates go on that upward trajectory, then that's very much a real issue. Can I just a question in relation to all this? Do you see, with the new Prime Minister starting her role and speculation around a stimulus, do you see, without getting into policy, do you see what would be the kind of challenges and dangers of what the bank does in terms of trying to act to bring inflation down, and what the government does in terms of fiscal stimulus and so on? Or indeed, the Lord Hammond said, former Chancellor said, that the tax cuts, that if tax cuts are given with some nearly 2,000 to high earners, that would deliver an inflationary stimulus. That's just an example of where the bank's activities could be in contradiction in terms of what government does, and not in sync. And I suppose at a time of crisis, what we do need is government policy to be in sync. What are the dangers of that, and how, where do you see the need for action in terms of making sure that everybody's kind of going in the same direction to bring inflation down, to protect the economy from a deep recession?
Well, I think it's obviously important to reiterate that monetary policy is operated independently by the Bank of England, and of course fiscal policy is operated independently by the government.
It's not kind of isolated completely.
No,
and
insulated. As Hugh said, I mean, we obviously take into account fiscal policy as it is set out and adopted and put into place by the government. And whatever is announced this week, we will do just that. We don't know.
Very quickly, though, sorry to interrupt, but on that point, Andrew, as we know, monetary policy takes quite a long time to work.
Yes.
18 months, 24 months, or whatever. Some of this fiscal stuff may be rather quicker and more of a sugar rush than that. Isn't that a problem, though? This mismatch in timing. You might not be.
As we always do, we'll take we'll take into account in whatever is announced.
But the reality is a tax break to very wealthy citizens is going to undermine what you do in the bank if you're trying to bring inflation down, isn't it?
Well, let me just reiterate. We will take into account whatever is announced, and I think that's the appropriate thing for us to do, and that's what we'll do. And I don't know what's going to be announced, so nothing else to go on.
I'll move on to another question. The bank's previous economist, Andy Haldane, was warning as early as February 2021 of the risks of a sharp and sustained rise in inflation, even as you continue to expand quantitative easing. Do you regret not heeding those warnings? I don't know if others want to come in.
Well, I have great respect for Andy, and we talked about this a lot when he was, obviously when he was on the committee before he left the bank. What I would say is this: Andy was very focused, I think, on a number of things. One was the snapback in activity at that point in time. In other words, an overall GDP in this country. And of course, there was an initial snapback, but then that's sort of unsurprising because there was a historic decline in GDP in the first stages of COVID. But since then, the path of the level of GDP has been very slow. So, as I said earlier, we are only just above the level of demand that we had pre-COVID. Only just. It has been grindingly slow since then. Now, I do want to bring in a point Silvana made earlier, which is a global point, which is this point about the rotation between goods and services, because it's important to understand what the composition of GDP has been. And I think Silvana said it earlier rightly, that there has been a slower reversal of that switch from services to goods than we expected. But that's a global point, I should say. It's most prominent in the US. That is relevant, but it's not actually, I think, to be fair to Andy, that's not the point he was making at the time. He was making an overall point. I think when I look back on it, and I do look back on it a lot, there were some key judgments that we had to make during this time. I don't think it's the judgment about overall demand, it's the judgment about the rotation that has turned out to be important. There were also, I think, some critical judgments we had to make about the labour market, some of which was when Andy was on the committee, some of which were not. But I think, if I may say, Andy was also making a point, I think, about the likely path of the rundown of the savings that were built up during COVID. Now, as I said earlier, we were looking at this yesterday. There has certainly, I think, been some rundown, but it's not been very large so far, I would say.
Right. Okay.
Can I add something, because you asked about we were still carrying out with the QE program. The evidence we have on QE and its effect on the economy is that it's very state contingent. It really depends on the state of the economy. So it tends to have a big effect when we face situations like liquidity crisis, liquidity shortages. Outside those episodes, the effect of QE on non-yields and hence on inflation and output tends to be small and short-lived. So in a way, the maximum effect came with the financial crisis, perhaps with the euro area crisis, and back in March 2020 when we had the dash for cash. Outside of those episodes, the effect on inflation and output should be very small. But let me just say why, the argument for keep doing it is that we were subject to enormous uncertainty, so QE was acting as a backstop. In the event we had a recurrence of those liquidity effects, then QE was there to step in.
Yeah, but if I could jump in here, I voted to end QE early. Not very early, because of course I didn't join the committee until September, but I voted at the next meeting to end QE earlier than it was originally scheduled to end, in part because I thought it was sending the wrong signal about the conduct of monetary policy. And that there was a time when we were making the adjustment from the accommodative stance and a continued accommodative stance to moving in the other direction with regard to monetary policy. With all, understanding the sort of the differences in the way that QE did work, there's the initial impact effect, and then there's a flow effect after that. It does send an important signal whether you are undertaking it or not.
In terms of the signaling, however, we were very clear that we would use interest rate as the marginal instrument, and so that was the background as well. We were cutting that signaling message at the time by saying that interest rates will be the marginal instrument for monetary policy.
My time's up, but I'd be very interested in knowing if there are lessons to be learnt, and there's clearly differences of opinion here on how we go forward in terms of forecasting, given we're so far off. I recognise the Ukraine crisis is a big contributor, given there's such a big gap between the target and where we're heading in terms of 13%, but also you did reassure us previously, Governor, that the increase in inflation was transitory, despite persistent questions about that and queries about that, and I was, among others, sceptical about the transitory nature of inflation. I'm going to have to leave, but
it's a real pity, because actually I'd be happy to answer that question, but maybe it's a
follow it up. Thank you.
I think I know what you'd say, actually.
Sorry?
I think I know what you'd say, actually, but perhaps you'd like to tell us. Yeah, let me give you a minute. Yeah, tell us. The transitory point.
I don't know the point. I mean, as we've discussed before, I do respond quite, forcefully to what I call with hindsight judgments. But I think you're absolutely right to say we had to make some very big judgments during this period. I'd single out very quickly the point I made earlier about the sort of the pace of overall recovery. But a lot of the big judgments have been around the fact, and I think this is where time moved on, and I think I would differ somewhat with Andy, over supply shocks. Now the transient point is this. We use the transient term when we were facing one supply shock, which was the supply chain disruption. I think that is pretty standard sort of economics with supply shocks. The problem we've had is that one supply shock was then followed without any break by an even bigger one, namely the war. And you can't, and it sort of comes to Catherine's point about expectation, you can't then say they're transient in the same way, because the time length for these things, even though they may work their way through in the same ways, is just too long. And that's the expectations point. There were big judgments about the labour market we had to make, and the two I'd single out. One was unemployment going to rise when the furlough scheme ended? Second one is the path of inactivity. Was inactivity going to come down when COVID receded as an issue? Seemed reasonable. It didn't seem unreasonable to think it would, but it hasn't.
Okay, thank you. I'm going to go to Gareth. Thank you.
Thank you very much. I want to hone in a bit more just specifically on the gas price element of all of this. Governor, both you and Hugh have described or highlighted that the gas market is extremely volatile. I think you described the extreme volatility, and certainly in August, gas futures were up 74%, I think, since May. 7 times
what day in August?
Yeah, true. But given you've described the extreme nature of the volatility, and Hugh was almost getting animated for a moment there talking about the volatility, it sounds like you feel the European gas market's out of control.
Well, I mean, of course, it's being affected by a huge shock, which is the behaviour of Russia, and we can't get away from that. What I think is important, and there's a lot of work going on this at the moment, is to say, is that huge shock causing volatility in the market itself? It's a pretty thin market, actually, by comparison with many other markets that we look at, and there's a lot of time being spent at the moment assessing that, because the consequences of that extreme volatility in the market are on both what I might call the buy side and the sell side of the market. So the buy side, obviously, this is obviously in this country, is often the energy suppliers that we all have in our homes. Obviously, the cost of financing those purchases when they're making them goes up a lot, and they have to make those in advance. But it also affects the sell side, which is often both the energy suppliers and the sort of the energy trading companies, because the margin, what the so-called margin calls that are having to be made for hedging in the gas market are now, of course, risen hugely. Now, that's necessarily a function of the increased risk that's in the market. But I certainly, and I talk to a lot of energy suppliers on this, there is a concern that it's actually leading A, to hedging not happening, B, to actually the markets becoming very thin. And that's important because obviously we rely on this pricing process, not least of all in the cap setting process. So that's, I can assure you, is this, it's obviously we're not responsible for the gas market, but we look at financial markets a great deal. So
sounds like the market's disorderly.
Well, it's under stress because obviously, if you've got a major supplier who is effectively cutting the supply off, and is making announcements to that effect, it is under a lot of stress. It's unsurprising in that sense.
Can I just make one point on that? I mean, at the risk of sounding animated, I think it is important.
What's wrong with that?
It is important to distinguish the perspective and I think Catherine and Silvana will bring, which is the respective of members. I mean, on the monetary policy committee, on the macro side of the bank, the monetary policy side of the bank. So of course it's unhelpful in our forecasting to have volatile variables, which are very hard to forecast by the nature of their volatility. And it goes a little bit to the chairman's opening remarks about my former colleagues and them finding a number which is very high, gets them on the front page of lots of newspapers because they choose the absolute peak in a volatile world. But for all the reasons we've been discussing, not least the fact that monetary policy is by nature a sort of low frequency, longer, medium-term oriented tool, we have to look through that volatility. So there's a certain amount of complication created by that volatility, which is unavoidable. And there's certainly a lot of activity within the Bank of England, appropriately so, and with colleagues elsewhere in the authorities to try and ensure that markets remain orderly and so forth and so on. But from the MPC, monetary policy point of view, I think it is important that we have to look through this volatility. So the big story is a story that a year ago, relative to where we are now, oil price futures of relevance for the off-gen price cap, which enters the CPI inflation calculation and so forth, they have risen, and of course it does depend on which time, with the specifics because of the volatility, but they've risen by a magnitude, an order of magnitude, right? So 7, 8, 11, you can choose different numbers which have a massive impact on your precise CPI forecast, but the big story is they've all gone up. And that has an impact on inflation, and one thing I think it's important to emphasize is that increase has also had a big impact on activity. So I just wanted to sort of use, if I can intervene slightly, we should be cautious, I think, about saying if we do fall into a recession, and that is what we forecast in our August report, and is certainly potentially possible towards the end of this year, I think it's important to emphasize, as Andrew has done, that's a consequence of the impact of higher energy prices on the real incomes of UK residents. Because we are a net importer of energy, what we are buying from the rest of the world is gone up in price very, very significantly relative to what we're selling to the rest of the world. And that has an impact on our purchasing power and ultimately on our demand and activity. So I think we need to be cautious about saying monetary policy is causing the recession. Right? Monetary policy, I think, is trying to manage a way to get back to target in the face of this massive external shock, where that massive external shock has had an impact on inflation and has an impact on UK activity. And it's precisely the fact that in the UK, as a net importer, that those two impacts go, if you like, in a painfully opposite direction. That's creating the trade-off that we are having to manage. And that's the big distinction that Andrew mentioned with what's going on in the US. The US is a net exporter of gas and other forms of energy, and the consequence, therefore, is they don't face that trade-off in the same way, and therefore they're able, perhaps, to speak differently and act differently in terms of monetary policy.
Okay, well, let's talk a bit about that in more detail then. Andrew, when you were in front of us in May, you described the situation as you feeling a little bit helpless given the driver of inflation being imported and a little bit of out of your control. If in the future, given the earlier discussion that the chairman had with you, gas prices don't feed through to consumers and they're actually taken out of this equation, would you then feel more in control of inflation?
Well, we'll have to see what happens. I mean, can I just
well, if they do, would you feel helpless still, or would you feel more in control, given that what Hugh's just said is that's what's been driving the uncertainty and the volatility?
It's an important question. I just want to just explain the sort of the helpless point, because in one sense the answer is yes, and in another sense the answer is importantly no. The answer is yes, in the sense that I'm afraid we can't control what Vladimir Putin does. Let's be blunt about it. What we can and must and will control is bringing inflation back to target as a consequence of whatever does go on, and there's no question about that. We will do that, and let me be very clear. We will stay the course to do that. So I want to make that's a very important distinction. Now, of course, if whatever transpires in the period to come causes the gas price to be less volatile and causes the gas price to move downwards, then that, of course, is an important input to our process. That's a very important input to our process. But I want to be very clear on this helpless point that, of course, whatever happens, we will bring inflation back to target.
Yeah, and just to reinforce that, monetary policy can always control the inflation rate. The difficulty is that it takes some time to feed through to the economy, but eventually monetary policy can be in control of medium-term inflation.
So I accept that. My point is that if the market prices do not feed through to consumers because of a government intervention, would you then feel more in control of inflation? Would you feel that you have more impact on inflation, the ability to impact inflation?
Well, let's see what. I mean, I don't want to prejudge what's announced. I mean, it must follow that if the future path of energy prices is more predictable as a consequence of any action, then that will obviously be something we will, we will put to use, as it were, and take into account. And to Hugh's point, I mean, this is the Goldman Sachs point. I mean, August was sort of probably the biggest illustration of this. I mean, it really did depend what day of the week you produced your forecast on as to what number you got out. These numbers were moving around in the outside forecasts, hugely from within a short period of time because of this volatility in the gas market.
Yeah. I think the point you're making, which goes back to the opening questions, is a point about there is an interaction here between developments in wholesale gas prices and developments in macroeconomic policies other than monetary policy. And we are having to sort of take both those things, informing our judgment how to set interest rates, set monetary policy to get inflation back to target. So I think that is a complex interaction. Our forecasts, and Andrew mentioned, we have done scenarios, for example, with different paths of wholesale energy prices, but we've always, and understandably so I think for reasons that you well understand, we've always said, well, we take fiscal policy as announced fiscal policy, because otherwise we're speculating on things that are other people's responsibility. But in thinking about our policy, of course we have to think about that interaction as it becomes. And the key point I want to make is that, and it goes back to where we started off, is for the UK, high gas prices as a net importer of gas, they have an income implication for the UK as a whole. Now that, given the system we had, fell very heavily on households, given the Ofgem price cap arrangement. We are now changing it. We're shifting where that falls, essentially shifting it. I mean, it depends on what measures taken and how they're funded, so I can't really speculate. But but the UK as a whole, at some point, has to bear that cost. And so the macroeconomic implications are not just about the impact on inflation in the short term, but through, for example, the fiscal accounts, which is where the emphasis of the early question was, or potentially other effects, they will have a macroeconomic effect down the line. And that's a much more complicated thing that we have to think about, and that will be the judgments we form in coming to it. So that's why kind of the knee-jerk, what's going to happen if we change the cap or we cap at a different level, I'm very cautious about that, because thinking about how this plays out at the relevant horizons for monetary policy is a more complex thing where we just don't have the information on there.
I'm at time, so thank you very much.
Interesting, thank you. Thanks, Gareth. Could I go to Harriet, Please.
Thank you very much, Chair. And Governor, I want to move on to your published plans. I know they're subject to a vote next week in terms of moving to sort of active quantitative tightening. And for some reason, that phrase from Jim Carville, President Clinton's economic advisor, who said, when I die, I want to be reincarnated as the bond market because then I can intimidate everybody. That keeps coming to mind. And I just wondered if you could confirm that you're meeting the Chancellor late today.
I am. I think that's been announced.
Okay.
And I can confirm that.
Will you be discussing the interaction between your proposals, again subject to vote, in terms of quantitative tightening and the trailed plans from the government to borrow potentially another £200 billion? Is that going to be on your agenda?
We had a short conversation on the phone yesterday evening after he was appointed and agreed to meet this afternoon, but there isn't an agenda. I would imagine it will be quite a broad discussion, but there's no agenda.
But do you think that this issue around your proposals to move into active quantitative tightening by effectively scheduling the sales of some of the gilts that you hold and needs to be coordinated with the government's fiscal plans and potentially with the debt management office in terms of just making it digestible for the markets?
Well, we have, throughout the process of planning this, and of course, by the way, the MPC's got to decide whether it wants to go ahead with this at its next meeting.
I appreciate it's subject to a confirmatory vote.
But we have kept very open lines of communication with the Treasury and the Debt Management Office, which I think is appropriate, particularly from the point of view of the operational and market side of this. So this is not about monetary policy, I should say. Obviously,
it's about the digestibility of this amount of gilts potentially entering the market in the short term.
We will, our team keeps this under very close consideration, and we do talk to the Treasury and the DMO about that.
So it will be on the agenda when you talk to the Chancellor this afternoon?
No, I'm not saying it'll be on the agenda when I talk to the Chancellor. What I'm saying is we have very open lines of contact with the Treasury and the DMO on this and other relevant subjects.
Okay. Can I turn to Hugh then and ask about the estimates that you've made economically in terms of how quantitative tightening can be compared to the kind of tightening that you might do through bank rate changes?
Yeah, so, we have, for the reasons I think Silvana already alluded to, we've been cautious about giving a sort of
You must have done one.
Well, let me explain why we've been cautious and the way I think we think about this. So, we published an article in the Quarterly Bulletin, I think in May, where we undertook an assessment of the impact of quantitative easing. And that did offer, although with a certain level of scepticism, I think, or at least appropriate confidence bands, a view of how many basis points you might think of as being equivalent to a certain amount of QE. And then we have cautioned about just translating that with a negative sign for QT for a number of reasons. The first reason is, and this just reflects things that Silvana said, so I won't go into enormous detail, but we do think that these types of interventions in markets have their biggest and most important effect when those markets are disrupted. So it is about kind of ensuring the market is functioning better that can have the biggest effect.
But do you accept that quantitative tightening of the scale that you're now potentially agreeing to next week, combined with the amount of additional borrowing that the government may announce in the next week, could in and of itself be a disruptive force in the gilt market?
So, I don't want to repeat things that Andrea said. The assessment made in interaction with the other authorities, but the assessment made by the staff who are responsible for considering market functioning and the operational issues at the bank, so not in the MPC, but my colleagues who are working on that, they are making that assessment. And so the quantities that will be considered when we come to the confirmatory vote next week have taken that consideration into account. Now, of course...
Have they taken into account the potential new announcement from the government?
Well, we don't know what it is yet, if you don't mind me saying so. So no, we can't do
that
until we know what... Well, we will do when we know what it is.
You will do when you know what it is, before next week's vote. Yeah.
And I do think it's important to say that, the logic, which is the logic that Silvana was referring to is the QT is not intended, for obvious reasons, to cause a disruption to market. So the program, which has been predictable and has a gradual element and reflects the principles that were established, again, this predates mine and Catherine's time, but in the communication about how QT would be done that was published in August 2021, I mean, that was all conditioned on the logic of we need to behave in a way to avoid disruption. So that means, first, that we don't want to create disruption, which I think is self-evident, and second, the magnitude of the impact of QT when it's implemented should be smaller than the amplitude of QE when it was implemented, because QE was precisely intended to dampen or avoid or run down.
Can I get you at least to make this statement?
I just might add.
Just a minute. Can I just ask Hugh? No, Catherine. I just want to get Hugh to say that quantitative tightening is a form of monetary tightening. You do agree with that?
I do agree with that.
Active,
yes. Can I mean, you're trying to get me, and I know Catherine wants to speak. What I think is important is quantitative tightening is tightening. Quantitative tightening, in our view, operates through its impact on asset prices. We can observe those asset prices. So the notion we have, which is key, is that we have said the active instrument of monetary policy during the process of tightening is bank rate, the traditional instrument. So by observing asset prices, and whenever we take monetary policy decisions, we're looking at all the data we see, as I said earlier, including asset prices. If we think the impact of quantitative tightening running in the background, gradually predictable and so forth, is, say, making asset prices yields in asset markets, for example, rise, tightening financial conditions, we can offset the macroeconomic impact of that by, if you like, doing less with bank rate. So we are in control of the overall stance of monetary policy by operating through bank rate.
Okay, can I just, before I bring in Catherine, ask you one more question about the unwinding of the counter-cyclical buffer. So you've announced that that's going to go from 0 to 1% in December this year and from 1 to 2 potentially in June next year. How much of a monetary tightening is that as well?
Well, that's not a monetary instrument,
it's not
right?
Monetary.
And I mean, I don't know if Andrew wants to
it has
about
no
that.
Contractionary impact in terms
we
of
of course
lending?
take that into account as we take everything into account. But the crucial thing is the MPC, in terms of its active instrument, meaning the instrument it's using to control policy now, is focused on bank rate. And we will take other things into account in order to do that.
I want to bring Catherine in. Catherine, what was the point you wanted to add?
I just wanted to say that amongst all of the people that we discuss these matters with, it's of course the markets. We also discuss with the markets and get intelligence from the markets about how they think digestibility is going to be going forward. So it's not just sort of on the supply side, so to speak. We also talk to the markets about what they see as their demand for the type of instruments that are being either quantitative tightening being sold into the market or that are being issued by the government. So the markets are ultimately the arbiter of the digestibility. And when Hugh was saying we have all these market prices across the asset classes, these are very important ingredients into our discussion about how digestible these things are.
Can I just say we would be interested to see when you have got some analysis of the impact of quantitative tightening and particularly some of the distributional impacts if you do something around that. And, if you do have something that you're ready to publish, we'd love to be alerted to it. Thank you.
That's right, I would certainly do that.
Thanks, Chair.
Thank you very much. I'm just conscious of time because I suspect the committee will want to be there for Prime Minister's questions. So we've got half an hour.
New Prime Minister.
We have 3 contributors, so if we can be disciplined, over to you, Anthony.
I'll be very disciplined. Thank you, Chair.
Thank you.
My questions are going to be about the remit, which you touched on earlier, but slightly more focused questions. So obviously the remit of the Bank of England, indeed the independence of it, came up during the leadership contest, although I think the Prime Minister clarified that she wasn't questioning the independence of the Bank of England, but was supportive of a review of the remit. Do you think the remit? So the remit has changed over time. It's obviously it came when it first came in. I think it was 2.5%, and it was RPIX, and then it got changed to CPI, and it got changed to 2%, and it has evolved over time. So there's nothing new about changing the remit. And I think certainly early on, the Treasury was formally committed to reviewing the remit at every budget.
What's your view of the remit? Do you think it's perfect, or do you think it's worth looking at whether any changes could be made that would mean we aren't in a situation where we know all the arguments about the external supply shock in Russia, but that would have led to a sort of smoother?
And actually, the remit was last reviewed in 2012-13 when some changes were made, particularly in the context of actually trade-offs, which are very important, and obviously in the current world. So yeah, you're right; it has been. As I said earlier, I think it is a good thing to review this sort of remit from time to time. Other central banks do that. I mean, the Canadians, for instance, have a formalised every 5-year review. The Federal Reserve and the ECB have reviewed without then have a regular sort of schedule, but they do it. And so I think it is a sensible and good thing to do. And actually, there was a plan to do one, I should say, in early 2020 when I was coming in as governor, which got derailed by COVID, frankly, and we just agreed.
Things to worry about.
Couldn't do it. So, as I think I was reported as saying a month or so ago, I really don't want to be interpreted in any sense, thinking that it's a bad idea to review the review. I think there are, however, let me say, some very important elements. So the foundational element of the nominal anchor, price stability, is very important. It's absolutely critical and goes with independence. But there's a lot of lessons we're always learning lessons, and that's important to do. But I think, it's obviously for the government to choose whether to do a review and what the subject matter would be. We've obviously, as we've been discussing this morning, got some huge tasks on our hands at the moment in terms of policy itself. But I want it to be very clear that, as a general matter, I think reviewing is from time to time is a good thing.
And what do you think the terms of a review could or should be? So there's one of the ideas that's been floated is actually not having an inflation target, as you mentioned, but having a money supply target. There's also been a long debate about having a nominal GDP target. I'm just wondering whether you think what you think of having different targets and whether it's worth even considering them.
Well, I think I said earlier, actually, so I'll have to stick. I don't think actually moving to a money target would be something I think would be a sensible step to make. There are a lot of debates around things like.
Can you explain why?
Well, I said earlier, I mean, it has not been a stable relationship over time, and essentially, the world moved on to targeting the end outcome, which is inflation, which I think is much better. And then we have tools to then get to that, and we have a whole bevy of sort of analytical approaches to understand of which money is part. Money is part. And I think that's the appropriate role for money, rather than it being the target, to be part of the analytical toolkit to understand how we hit the target. There is a whole debate about nominal GDP targeting. I think not something I must say I think is obviously an improvement, let me put it that way, but there's a very wide debate on it, and it's sensible to have that debate. But there's a lot that, when we talk about reviewing, it's not just about is it an inflation target, is it a nominal GDP target. As you know, there's a lot more to the remit than that. As the 2012-13 review showed, there's some very important questions about how you put it into practice and interpret it. Sorry,
Savannah, you're trying to go.
Yes, I mean, if you're interested, the 2013 review had a big discussion of nominal GDP growth targeting and comparing it to the framework that we have, flexible inflation targeting. And I think the conclusion there in that comparison, and it's also the conclusion from the literature, is that these different targets, flexible inflation target or nominal GDP growth targeting, don't lead to significantly different outcomes, because in a way our remit asks us to put some weight on output. So it has some flexibility embedded and some weight put on the activity side. What nominal GDP growth targeting does is fix a weight on growth. And so in some sense, it has less flexibility than the flexible inflation targeting that we have. The other difficulty is more practical. With GDP is subject to big revisions. The timeliness is less than with inflation figures, so it's harder to chase and target. And then the other thing, finally, I think, is that for households at least, it's easier to understand inflation than GDP and nominal GDP. So it's
that's true. But obviously, what really matters is the sort of economic impact.
In terms of the outcomes, if you look, try to simulate the outcomes that you would obtain from a flexible.
I've seen the comparison charts.
But the GDP deflator is not a very intuitive measure of price. No.
Are there other changes that you think might have an impact? So one of the other suggestions I saw from an LSE academic was actually changing the width of the reporting mechanism. So instead of being plus or minus 1%, you can make it plus or minus 0.5% before you have to write a letter, and maybe write a letter every 2 months rather than every 3 months. It sort of tightens up the thing a bit, and might be. And their argument was that it would be less of a surprise when things diverged.
As a product of COVID and the war, I've written a letter every time I've had to, except for one occasion when it was passing through. So, all of these. I don't think, to be honest with you, I don't think these are sort of first order issues. But all of these things obviously could be looked at.
Do you think? Finally, my last question, just to sort of put, do you think we're obviously the political background to this is that there's a sense of surprise that inflation is going up so high, and there's the accusation that you started raising interest too late. We've been through this. I know all the arguments. I'm not saying I agree with it. But do you think there's anything? Do you think there's any change to the remit that could have meant we're not in this situation?
Well, I'm trying to avoid rerunning the earlier discussion. Obviously, as Hugh was saying, the by far the largest contribution to this is the war.
Yeah, exogenous pressure.
And that's not sort of something that's, I'm afraid, within the remit of monetary policy.
Yeah. Okay, that's all my questions. Thank you. We've lost the attention of the chair. Shall I temporary chair?
You can do simulations of what would happen with, for example, a strict inflation targeting regime as opposed to a flexible inflation targeting regime.
Yeah.
So if you had a strict inflation targeting regime, you would want inflation at 2% exactly right now.
Yeah.
That would have required, again, having the information about the war back then in the midst of the pandemic, raising rates to double digits, unemployment to double digits, and then being ready for a big undershoot on inflation in the medium term.
Yeah.
So you would have had a very difficult time trying to comply with a strict inflation target that would apply to today, because then you would miss the target going forward and enter into a deflationary economy.
Okay, thank you very much. I had stopped earlier, but you were distracted.
That's excellent, doing really well, thank you. And in fact, finally, because Siobhan has very kindly agreed to withdraw to allow us to leave a little bit more punctually, so thank you very much for that. Alison.
Thank you very much, Chair. I've got some questions around the prospects of a recession, and you've been very clear, and I agree with you that the inflation that we're seeing is a consequence of the war in Russia and of Putin's actions, and you've been very clear about your views on heading towards recession, that you want to avoid that, but it is very much what you are predicting. And I don't want to kind of go into the predictions much further, but I want to ask, in a very technical sense, given what Catherine and others have said about entrenching inflation, do you believe, as policymakers, that a recession is necessary?
Well, I come back to the point that I think you can take from the August report that we think, unfortunately, the most likely outcome is that there will be a recession, but that the main cause of that is the war and the effect on real incomes and the effect on demand. So, in terms of is it necessary, I'm afraid it's a consequence of that. So I think the necessary question tends to go to, are you going to do it through monetary policy because you think it's necessary? And I would say the main reason it's going to happen is not monetary policy.
Yeah, so there's very little you can do to stop it then in that effect?
Insofar as the war is having this huge effect, the answer to that would be no. Now, maybe I'm jumping ahead, but if you ask me the question, well, do you therefore think is it therefore the case that you would not use monetary policy in a way that would? Then I'm afraid the answer is that we have to hit the inflation target. And we have to take the actions we need to take to hit the inflation target, hard though those may be in terms of the consequences. And don't take that as a prediction as to what we're going to do next. It's merely my observation that the recession, if it happens, will be driven not by the actions of monetary policy, but I just want to make it very clear that we will have to use monetary policy to hit the inflation target as we think appropriate at the time.
Okay. Perhaps I could ask Catherine, since she talked about the issue of entrenching inflation. Do you believe the actions are necessary, a recession would be necessary to avoid that entrenchment?
I agree with the assessment that the recession is a consequence of the energy price hikes, the war in Ukraine. The reason for, and that is the vastly dominant driver of the recession that was forecasted in the August monetary policy report. Where I come down in terms of deploying the monetary policy tool is that entrenching the inflation expectations that are being driven by those oil price or energy price increases. The short-term energy price increases that are becoming entrenched in medium-term inflation expectations. It is the role of monetary policy to lean against those entrenched inflationary expectations, because what happens after in the time of a recession that is being driven by oil prices or energy prices and other prices, I might add, there are some other external shocks as well, that when we go through that, then you end up having entrenched expectations above the 2% objective. And then monetary policy has to work even harder to get rid of those entrenched expectations. So I look at the entrenchment of the medium-term inflation expectations. I look at that as something that we do have to deal with, because if we don't, in the medium term, our monetary policy will have to be tighter than if we dealt with it now.
Okay, thank you. Moving on slightly to the issue of energy prices. Hugh, perhaps can you tell us a wee bit more about what the price cap rises do to demand and to growth within the economy?
Well, and I think it works through the impact on household incomes. I think just to perhaps put a retail spin on the magnitude of the shock, we've talked a lot about it at kind of the wholesale level. As I'm sure you all know, medium household income in the UK is about £31,000. The price cap from Ofgem, which of course is kind of average, no one is really, but that was about £1,000 a year ago. It's set to rise significantly above that, and on the basis of the mechanical exercises we discussed right at the outset of the hearing, numbers in the 5,000, 6,000. So if you sort of take the gap there, £5,000, that's a sixth of household income. So you can see the profound effect that has on disposable spending power for the average household, and that's the mechanism through which it can feed through. Now, we have to make, and Andrew has alluded to this, a whole set of judgments around our base case, a whole set of judgments about how that feeds through into spending, depending on how that's distributed across households. It is the sort of perfect storm of a shock that's affecting the least well-off most. The least well-off are not those who've accumulated savings during the lockdown period. They're not those who have access to financial markets so can borrow to smooth their way through these things. So effectively, they are more reliant on fiscal policy being an opportunity, and that's why the fiscal policy choices, which we're still very uncertain about, can have quite a significant effect on the real developments in the economy, because they will affect how that plays out. But all those issues interact with confidence, how these fiscal measures might be funded, and so forth and so on. So this is exactly, as I said to Gareth earlier, these are exactly the interactions between developments in wholesale energy prices through all these things into ultimately the spending power and redevelopments in the economy. So we have, in our August forecast, which of course made some concrete assumptions about this, we had, I think, post-tax labour income fell about 3.5%, given the rise in energy prices and its feed through, on the assumptions that were embedded then. and household disposable income fell by about 1.5%. And so these are, by historical standards, very, very big negative downturns to the spending power of that on consumption.
Yeah, and if the price rises take place as predicted, everyone's household energy bills will have quintupled in the space of 2 years. Is there any precedent for this?
No, and I think, as Andrew said earlier, I mean, if we compare this with the 1970s, which, I mean, is not always a comfortable, but is certainly a natural comparison that people make, I mean, the impact of rising utility bills as a proportion of household income, I mean, the numbers I gave earlier, if you apply them on average across we're talking about somewhere between 5 and 7%. The equivalent number in the 1970s is somewhere between 1 and 2%. So it gives you, just to emphasize, what I've tried to emphasize on previous interventions is the magnitude of this shock under the assumptions that we are having built in to the framework for energy pricing and so forth is just really without historical precedent.
Thank you. We've not really talked so much about the outlook for businesses on this. And I've got a business in my constituency who came to see me last week whose electricity prices are going from £160,000 annually to £712,000 annually, just to get in a contract. That's not even what that might end up being. They make sausages and pies. You're not going to see the prices of sausages and pies going up the equivalent of that. So I wondered, what analysis are you doing about the impact on businesses? Are these going to be businesses that are just going to go to the wall because they can't afford to make these bills, and what will be the wider impact of that?
Yes, I mean, I think you're right. The focus of a lot of the public attention over recent months has been on the household side, but the impact potentially on the corporate side is massive. A lot of corporates were into fixed contracts that now expire, actually next month, and if they're forced to, essentially buy at the spot price that's being offered, this is going to be a massive shock to them. And we know that would imply, for the reasons you're saying, particularly for consumer-facing businesses that are seeing a weakening of demand on account of the household behaviour, but are also finding inputs, not least energy, but other inputs which are pushing them up. The cash flow squeeze on them will be very, very profound. Many of these businesses are businesses that borrowed during COVID, and some of them for the first time borrowed. And of course, interest rates have risen. So this is a complication which could lead to higher business failures. And of course, it's why fiscal measures that we may hear about, I mean, they may apply to the corporate sector as well as to the household sector. And then we will have to do the analysis that we've been discussing. Mm-hmm. But the risk... Sorry, Catherine.
Yeah. No, I was just going to note that we get quite a bit of information from our agents about how businesses are faring with regard to changes in their input costs, a variety of them. And so we really do feel like we have a pretty good handle on the situation facing business. So that is very much part of our analysis. There's both surveys of the businesses as well as sort of ad hoc agent commentary. So it's a very rich fabric of information about what's happening at the micro level.
Okay. And is there anything the bank is going to be able to do on this?
Sorry?
Is there anything that you're going to be able to do about this in a practical sense? Because this is a crisis.
Yeah. Well, I think from a monetary policy point of view, I mean, monetary policy is potentially a very powerful instrument, but it's also a very blunt instrument. Yeah. And a lot of what we are talking about here are to do with distributional effects. I mean, the point I was trying to make earlier is wholesale gas prices are being determined in international markets. The UK is a net importer, so we have to pay that wholesale gas price. The question at hand, really, which is not a question for monetary policy, the question at hand is that shock, which is unavoidable to the extent we keep using gas in this country, and we are locked in to a large extent using gas, at least in the short to medium term. Who covers that cost? That is the issue, and that really is for people other than us. I mean, so our agenda is, given all of that, how are we going to set interest rates in a way that gets us back to target? And by getting back to target, for all the reasons that Silvana and others have talked about, we're providing the environment where those policies can work most effectively.
Thank you. Alison, thank you very much. Brings us to the end, nicely in time for Prime Minister's questions. Thank you so much for coming to see us today. It's always very informative to have you appear before the committee. Very difficult times. And thank you also for coming so close to your next meeting. Given the strictures that we respect as a committee, and we wish you well, and thank you very much. That concludes the session. Order. Thank you.
The proceeding has ended.